On the y-axis, we have account balance. On the x-axis, we have position sizing. Now, for this illustration, we assume that we're always risking 1% of our account per trade and that our fixed costs remain constant. Now, the first thing you notice is that as the account balance increases, we can trade bigger position sizes. Now, because we're not extracting the profits from our account, we're effectively reinvesting them, and as a result, we start to see account growth. Now, as we see the account grow, we start to see that we can take on bigger position sizes. Now, the next thing to focus on is the yellow line, and this is our fixed cost. This includes things like software fees, desk fees, your Bloomberg terminal, your commissions, as well as the wage you want to pay yourself. Now, the difference between where your account balance is and where that fixed cost line is, we call the operating cost gap. Now, very important, the wider this gap, the greater the degree or the greater the margin of safety. So more importantly, the wider we see the gap between our account balance and our fixed costs, the more money that's being reinvested into our trading account every single month. Now, it's important to notice that in this zone 1, in this initial zone, notice how flat the account growth is. And this is because fixed costs make up a significant percentage of your account growth and the profits you extract from the markets. Basically, in the initial stages, you're just surviving and trying to cover costs. So it is hard. Now, with a smaller account balance, the task becomes even more difficult. Why? Because those fixed costs make up an even bigger proportion of the account balance. Now, as a rule of thumb, your monthly fixed cost should never exceed 5% of the account balance for two reasons. One, making 5% a month is hard work. It's not easy. Sure, in some conditions it's easy, but generally speaking, over a period of a year, making 5% a month is really good trading. And secondly, is you don't want excessive fixed costs that burden you and force you to have to trade to break even. Now, what is the compounding effect? Well, this is the point where our operating costs become insignificant. In other words, the point at which your fixed costs are roughly speaking less than 1% of your account balance per month. At that point, we reach a significant point called the compounding effect. For the simple reason that almost all of our earnings, all of our upside we're taking out of the market is being reinvested into our account balance. It's at this point that we see the significant steepening in the account balance. Okay, the point at which we start to see that steepening we call the career pivot. Why? Because it's a magical moment in your career as a trader where the pressure valve is simply released. Why? Because your costs are so small, all the money you're making is being reinvested, and you're trading bigger positions almost weekly. Few traders ever get to experience this point because they battle to understand the importance and necessity behind increasing your position size and increasing your account. So the trick is, in the initial part of your career, you must reinvest as quick as possible to get to that career pivot, because once you get to that career pivot where operating costs are significantly small, at that point you get to the magical career pivot point. Now, the reason traders are stuck on one lots or trading micro lots or very small position sizes is just because they lack enough compounding of their account growth. It's as simple as that. They're not reinvesting sufficient profits back into the account.